Now, there's arguments, and they're no doubt valid, that silver's been restrained. Well, to the extent it's been restrained, then an error has occurred, a pricing error. And when a market makes an error and compensates for it, whether it's an excessive upside or excessive downside, quite often the compensation for the error overshoots the new, more valid reality that it should have been in. So if silver should be in a $200 to $300 range, maybe it goes to $500 first, overshoots it because excess begets excess. And so I think what we're going to see is something along that line.
For decades, silver has existed inside a structural contradiction. It is one of the most historically important forms of money ever used, yet it has spent nearly half a century trapped in a narrow price range that stands in sharp contrast to the behavior of almost every other major commodity. Michael Oliver's work begins with this anomaly. His analysis does not assume the silver market has simply been quiet or inefficient. It assumes something more consequential, that silver has been mispriced for so long that the eventual correction will not be linear, gradual, or polite. According to Oliver, markets that correct long-standing pricing errors do not merely return to fair value. They overshoot it. Excessive suppression, once resolved, tends to produce excessive upside, and silver now appears to be approaching that inflection point. What makes Oliver's current outlook especially significant is the scale of the move he now believes is possible. Where earlier projections placed silver in the $200 to $300 range on a monetary adjusted basis, Oliver now sees a credible path toward much higher prices before any lasting correction takes place. His framework suggests that silver could reach as high as $500 per ounce during the compensation phase of this repricing cycle, driven by relative performance breakouts, historical precedent, and the re-emergence of silver's monetary role. These are not speculative assumptions. They are signals derived from the same analytical methods that preceded silver's explosive advances in 1980 and 2011, and they are beginning to align once again as we enter 2026. In the clips ahead, Michael Oliver explains why recent volatility is not a warning sign, but a defining feature of an emerging price regime, why traditional pullback logic may fail investors during this phase, and why silver's decades-long confinement is now giving way to a radically different reality. We will also examine the monetary forces behind this move, the historical parallels Oliver draws from other commodities, and what investors should be paying attention to as this cycle accelerates. If you find this analysis useful, consider subscribing and stay with us through the full discussion, because what lies beneath the surface of the silver market right now is far larger than most investors realize. We appreciate the support and hope you enjoy the video.
You got to be aware that what's underneath this beast, in our assessment, and so far we're right, is that it's going to a new reality. Silver's not going to have another $50 up move out of the range from 0 to 50 basically for 50 years and go up, and everybody's going to think around 100 naturally. Oh, that's a swing move, the dimension of the prior base. We think we're going to a new reality in the hundreds of dollars. And I think we're going to do it in about 6 months. Our clock started at the close of November. At that time, the price of silver was in the mid-50s. It was based on a signal we got from our relative performance analysis, spread chart analysis of silver versus gold, gold versus the S&P, gold miners versus gold. All of these metrics said, we just shifted in a big way at a relative performance basis. When that occurred in 79, in the rush to the 1980 high, and in 2010 to the rush to the 2011 high, both big multiple gains in 6 months, that spread broke out, silver versus gold. We've had a situation since 2020, basically, of silver sort of underperforming gold. It's going up in price along with gold, but less so. And therefore, the spread relationship has been like a capped off. You broke through the cap at the November close. Now, and sure enough, if you use that as your metric, and it said, this is just the beginning of a massive shift of silver versus gold and also of net price, then the clock just began there. So it's not old, it's fresh. And our argument is, looking at lots of metrics, that silver is likely in the next 6 months to minimum reach a couple $100 and possibly more than that in going to a new reality. Not this 50-year range has been confined, in which most actually commodity markets have not been confined in that sort of range. Copper hasn't, lead hasn't, but silver has. And it's saying no more, okay? And it's not going to do it in a slow staircase, corrective process manner. So what we've stressed to our subscribers for some time is that you've got to somewhat ignore the type of events that we just had yesterday, which, usually it takes a week or so and you get a 10 or 15% pullback, and then it takes you a couple months to go up and take out that high. Look back at October is a good example. We hit a high and we had a sharp break that lasted a couple weeks. Much of it occurred in the first week, but you couldn't get back to the high for about 3 or 4 weeks later. So you got whacked, but still it was pretty fast recovery given some of the other behavior of silver the last few years. This time it was 24-hour event. We went from a futures high at 82, dropped down almost to 70, and turned around today and hit 78. I mean, it didn't fool around. It didn't base. It didn't prove itself as support before it turned up. It just said, bam, back up, okay? In fact, we're back up trading now above the high close that occurred, high settlement price on Friday. So this is the kind of behavior that investors need to be aware of, that it is going to be part of this explosive advance, and just don't get upset by it. In fact, if you try to get out, the problem is getting back in, because sometimes it's not going to give you a nice base from which to buy from. It's just going to go whap right back up, and you'll say, what do I do now? So anybody who got out yesterday in the middle of that collapse, for example, is already behind if they buy back in. Don't get out. Now, in about 6 months, we'll be trying to define a place to then get out after silver has reached a new reality, because there will be major correction at some point. But I don't think you're going to see it until we get well into the second quarter. Well, I mean, when the spread broke out last month, forget the net price of silver or gold. Quit looking at their charts, okay? But when that relative performance spread broke out, it broke through a multi-year high of where silver had continually gone to bump against the price of gold, where it created a ceiling of resistance that it couldn't perform better than that level. When it broke through last month, silver's up $22 on the month. 1 month. It's already been in a bull market. Why did it suddenly go up $22 in 1 month? The spread said the game has changed. And I think the game will continue for a couple quarters. And once it's over, we'll look back and say, oh, golly, wish I were there. Well, the way to stay there is to stay long until certain metrics that we're monitoring say, okay, now we've maybe reached the level and probably even overshot a reality level. So if silver is justified to be a couple $100 an ounce, like if you take M2, money supply, and go back to 1980 and factor in the money growth, the depreciation in the buying power of the US dollar, and then calculate where silver might be a couple $100 probably. There's no question about that. But if that's where it's going, it's likely to overshoot it, as most markets do. If they've made a big mistake, they often overshoot the correction of the mistake. And so be ready for that. And there's another thing going on with silver that people seem to be focused on silver itself, like the industrial supply-demand deficit that's been around for 5 years now. Why didn't it work 3 years ago? Well, suddenly it's starting to work. Okay. Well, you don't have enough silver to meet demand, especially high-tech demand. Everybody's focused on those aspects of silver. And also they're all panicked by the potential that, oh my gosh, the COMEX will raise, the CME will raise the margin requirement. Well, they've been raising it all along. I think it was like a 13% jump on Friday, in fact, where they raised the margin rate. And in 1980, the chairman of the COMEX, who I knew, because he'd trained me as at E.F. Hutton. I worked under him. He was the head of Hutton's commodity division in the mid-'70s. But he stayed the chairman of the COMEX till 1980, and he imposed no buying, ceased buy orders. Silver's at $50 then. It had gone from about $3 to $50, okay? And the market crashed, okay? They think, oh, all they have to do is somebody on the outside, like in an exchange here or there, can push a button and stop this bull market. They don't realize what's really underneath the surface here. It's not merely exchange margin rates that are causing silver to go up too much. It's that industrial supply aspect, but it's also primarily the monetary issue. Silver is money. It's been money for 3,000 plus years.
Oliver's argument is rooted in relative performance rather than headline price alone. He places particular emphasis on the breakout of silver versus gold, gold versus equities, and miners versus bullion, relationships that historically shift only at major regime changes. When these spreads broke decisively at the close of November, Oliver's internal clock began. In his assessment, this was not a late-stage move, but the opening phase of a new cycle, one that resembles previous 6-month surges that produced multi-fold gains in compressed timeframes. As we transition toward the second part of the interview, Oliver broadens the discussion beyond silver itself. He draws comparisons to other long-suppressed commodities such as copper and lead, which also spent decades in range-bound behavior before rapidly repricing into entirely new value zones. These analogies set the stage for a deeper discussion about what happens after a breakout, how markets establish new realities, and why silver's underlying fundamentals suggest even greater upside potential than those historical precedents.
What are some of the things that you'll be looking at in that regard to trim some profits if we do see, $100, $200, $300 silver?
Well, let me put it this way. Let's talk about gold, the mama market right now. Since legalized in 1975, gold's had two major bull markets. One from the 1976 corrective low, just above 100. It rose to 850 in 3.5 years. That's an 8-fold gain. Okay, 8 times the bear low. 2001, after a lengthy pullback and then basing at a price of around $260, it finally bottomed and turned up and went to 1920, another 8-fold move. Took it 10 years, different time span, but the same multiple gain. The conditions then weren't anywhere near like what we're talking about now, the fundamental underlying stability issues. Well, gold made its bear low in December 2015 at a price of $1,050. We're fourfold, only half as much gain on a multiple basis as were those two prior major bull markets. So, yeah, when you look at an arithmetic chart, it looks like, oh my gosh, it's been parabolic. No, it's only half as much strength as we exhibited between 76 and 80 and 2001, 2011. So if gold even just matches those multiples, it would be well over 8,000. That's just matching those. That's not exceeding. I don't set that as a target. I'm just pointing that out. Frankly, I think if it ever got there, you go way beyond. And also, I think the next outcome of this situation that has been unfolding and will suddenly now more rapidly unfold, silver stating that, you'll have fundamental factors that smack everybody in the face, like jeopardized government bond markets, central banks out of control, and you'll find gold and silver possibly being monetized. This country, that country, this country. And what will drive that is the pain that hits the public in these various countries and also their sense of uncertainty. And the one thing that makes them feel certain, okay, growing affection for the monetary metals. So I think once this next bull occurs, it's not likely to collapse. It's likely simply to become institutionalized. It's already becoming that way. We're close to that in certain countries in the world. And if this crisis hits as we think it will, it's going to be far more broad. Even the Western countries will suddenly have to rethink their notion of what's acceptable, what's a good norm to proceed on. Is it still central banks playing their boom-bust game? Every other year or so, they inject money, the stock market goes up, then suddenly it busts, and they inject more money. You get the point. And so I think we'll have a rethink where instead of a quote, like you said, a bubble top, yeah, you'll have some sell-off, but I think you're going to likely be institutionalized at much higher levels. And a lot of that movement could occur this coming year with other markets. Copper was in a range from the 1970s, 80s, 90s into about 2005, basically $1.50 to 50 cents a pound. Up and down, just like silver, $50 to 5, $50 to 5, for 50 years. Well, copper was in one for multiple decades. And in late 2005, it emerged above the top of that price range. Now, no doubt momentum factors would have told you ahead of time that's going to happen, just like it did with silver, for example. But then price broke out of the range. But what happened is it went to a new reality that was quadruple the average price of that prior reality, which let's call it $1.50 to 50 cents for decades. And suddenly it went into a range that had highs at $4.50 to $3, and you could draw a sideways line since about 2006. Of course, copper's living in this zone of price that if you took the average of that price zone versus the average of the old price range, it's like a quadruple. And that occurred in a matter of a couple quarters, the movement from one to the other, and then you're in a new reality. The same thing happened at a different time totally, so not coincident with copper, with lead. Lead had been in a multi-decade range, broke out, and it quadrupled in a matter of a couple quarters and lived in a new reality. Now, there's arguments, and they're no doubt valid, that silver's been restrained. Well, to the extent it's been restrained, then an error has occurred, a pricing error. And when a market makes an error and compensates for it, whether it's an excessive upside or excessive downside, quite often the compensation for the error overshoots the new, more valid reality that it should have been in. So if silver should be in a $200 to $300 range, maybe it goes to $500 first. Overshoots it because excess begets excess. And so I think what we're going to see is something along that line. And I think silver has even more arguments than copper or lead did. We know what they are. And it's not just the industrial aspect of silver. It's the monetary underlying massive wave that it's riding. During the year, I think we'll be well in the hundreds on silver. I'm not going to try to pin it down. I just explained that monetary factoring back, you could be a couple $100 just to get even to 1980, for example, or 2011. It'll overshoot that level, but something very dramatic is going to happen, and it will not be incremental. Meaning, if you're not in now and you come in 3 months, you'll be really chasing something. And also, you've got to learn that until that clock gets older, and we're monitoring closely that process, you've got to somewhat ignore the sell-offs. And instead, if you just go back to last year and say, if I bought every 10 to 15% pullback, would I be better than the guy who took profits? Yes, you would. Massively better. If you just said blindly, is it down 10 off the high? Buy it, okay? Your average entry price would be far better than the average guy. And that happened yesterday, okay? If you bought silver at 71 or 72, you're already up $6. Okay. So hang in there. A lot of it should happen by second quarter.
Michael Oliver's outlook for silver and gold is ultimately grounded in a broader monetary context that investors can no longer afford to ignore. At the core of his thesis is the reality of persistent monetary debasement, the expansion of money supply, the erosion of purchasing power, and the growing instability of sovereign debt markets have created an environment in which traditional financial assets struggle to preserve real value. In such conditions, gold and silver do not merely function as commodities. They reassert themselves as monetary anchors. Oliver's analysis suggests that silver, long dismissed as a secondary monetary metal, is now reclaiming that role with force. What strengthens this argument is the increasing institutional and governmental recognition of silver's strategic importance. Industrial demand continues to expand, particularly in high technology and energy applications, while supply deficits persist year after year. Yet Oliver is clear that industrial fundamentals alone do not explain the magnitude of the move he anticipates. The primary driver is monetary. Silver has served as money for thousands of years, and that historical function is once again being acknowledged in policy and strategic planning. The recent designation of silver as a critical metal in the United States is not symbolic. It reflects a deeper recognition of its economic and strategic relevance in an era of systemic uncertainty. Oliver's comparisons to past gold bull markets further reinforce the plausibility of his projections. Gold's previous cycles delivered eightfold gains from major lows, yet the current advance has only achieved roughly half that multiple so far. When viewed through this lens, today's price action appears far less extreme than it is often portrayed. If gold were merely to match historical performance, prices far above current levels would be mathematically justified. Silver, which historically exhibits greater volatility and larger percentage moves, would logically experience even more dramatic repricing during such a phase, particularly after decades of relative underperformance. Crucially, Oliver does not frame this cycle as a brief speculative blow-off followed by collapse. Instead, he anticipates a process of institutionalization at much higher price levels. While sharp corrections will occur, he expects the broader trend to resolve into a new long-term range, much as copper and lead did after their respective breakouts. In this framework, volatility is not a signal to exit prematurely, but a mechanism through which the market transfers ownership from short-term traders to long-term participants. Investors who mistake these moves for tops risk being permanently left behind as prices reset higher. As we move deeper into 2026, Oliver's message is fundamentally optimistic. He sees a monetary system approaching a point of forced reevaluation, where confidence in fiat instruments continues to erode and tangible monetary assets regain prominence. Silver, in his view, stands at the intersection of monetary history, industrial necessity, and technical breakout. Whether prices ultimately reach $200, $300, or overshoot toward $500 before stabilizing, the implication is clear. The era of silver suppression is ending. For investors willing to engage with the data rather than the noise, this cycle represents not just an opportunity, but a defining moment in the precious metals market. If you found this analysis valuable, please like the video, subscribe to the channel, and share it with others who are closely watching the monetary landscape. Thank you for spending your time with us, and we look forward to continuing this discussion as the year unfolds.